No matter if you're studying or cooking, this is more important. The market just collapsed 30%. And this was not normal. Most people think market crashes are caused by panic. They imagine traders screaming, headlines flashing, and people hitting the sell button. But markets don't collapse because of fear. They collapse because systems reach limits they can't escape. A 30% crash is not just a bad month. It's a financial earthquake. Trillions of dollars disappear. Retirement accounts shrink. Companies lose capital. Consumers stop spending. Confidence disappears. To understand what just happened, we need to go back in time. For more than a decade, the world lived in an era of extremely cheap money. After the 2008 financial crisis, central banks lowered interest rates to near zero. After 2020, they printed trillions more. In the United States, the Federal Reserve balance sheet went from less than $1 trillion in 2007 to more than $9 trillion by 2022. Europe, Japan, and China followed similar policies. This became the largest monetary experiment in modern history. Cheap money changes behavior. Companies stop saving and start borrowing. Governments stop taxing and start borrowing. Consumers stop waiting and start borrowing. By the mid-2020s, global debt surpassed $300 trillion. That's more than 3 times the global economy. In 1980, global debt was close to 120% of global GDP. Today, it is more than 330%. This kind of debt level usually only happens during world wars. For years, the system looked perfect. Stocks reached record highs. Real estate surged globally. Technology companies became trillion-dollar giants. Crypto markets exploded. People believed the system had changed forever. But cheap money is like oxygen. You don't notice it until it disappears. When inflation returned after 2020, central banks had no choice. In the US, inflation reached over 9% in 2022, the highest in more than 40 years. In Europe and the UK, inflation also reached multi-decade highs. Central banks raised interest rates aggressively. Interest rates are gravity for financial markets. When rates go up, asset prices fall. Future profits become less valuable. Debt becomes expensive. Speculation becomes dangerous. Companies that survived only because of cheap loans suddenly faced reality. Investors realized something shocking. The entire system was built on the assumption that money would stay cheap forever. So selling began. But humans were not the main sellers. More than 60% of trading today is done by algorithms. They don't panic. They follow code. When the market dropped 10%, machines sold. At 20%, margin calls forced funds to liquidate. At 30%, leveraged strategies collapsed. This is called a liquidity cascade. It happened in 1929. It happened in 1987. It happened in 2008. And it happened again. Another key factor was valuation. Before the crash, stocks were extremely expensive. The Shiller PE ratio was near levels seen before the Great Depression and the dot-com bubble. Investors were paying for profits decades into the future. When interest rates rose, those future profits became much less valuable. Prices had to fall. This was not emotional. This was mathematical. But this crash was different from 2008. In 2008, banks failed. Mortgage derivatives collapsed. The financial system froze. This time, banks were stronger. The problem was everywhere. The entire global economy was built on debt and cheap money. US federal debt surpassed 120% of GDP. Japan exceeded 250%. Many European countries crossed 100%. Historically, when debt gets this high, governments face only 3 options: default, inflation, or financial repression. Default is politically impossible, so inflation or repression becomes likely. After World War II, the United States used inflation and interest rate controls to reduce debt. Cash savers lost purchasing power for decades. Asset owners became wealthier. In the 1970s, inflation surged again. Stocks struggled. Gold increased more than 20 times. Real assets protected wealth. Cash lost value. History is not repeating, but it is rhyming. Now, What happens after a 30% market collapse? History gives us several paths. One path is a lost decade. Japan experienced this after 1990. Their stock market collapsed more than 60%. It took more than 30 years to recover. Growth stagnated. Debt exploded. Interest rates stayed near zero forever. Another path is an inflationary boom. After the Great Depression, governments spent massively. Growth returned, but inflation surged. Cash lost value. Assets rose. Another path is financial repression. Governments keep interest rates below inflation to reduce debt. This silently destroys cash, but supports stocks and real assets. This has happened many times in history. Another path is a technological supercycle. AI, energy, automation, and biotech could boost productivity. This could create massive growth, but also massive bubbles. So what does this mean for normal people? Market crashes are not just Wall Street events. When markets fall, companies cut jobs, banks reduce lending, governments increase control, inflation or taxes rise. The middle class always pays. There is also a psychological lesson. After 1929, people avoided stocks for decades. After 2008, people avoided real estate. After 2020, people avoided markets again. The biggest mistake is waiting forever. Time in the market beats timing the market. Every major crash in history eventually recovered, but those who waited missed massive growth. The real danger is not crashes. The real danger is stagnation. If inflation is 3% and your savings earn 1%, you lose wealth every year. A crash is visible. Inflation is invisible. This crash could reshape the world. More government intervention, digital currencies, capital controls, deglobalization, regional economic blocs. Every crisis reshapes the system. The Great Depression created modern welfare states. 2008 created massive central bank power. The next crisis may reshape money itself. The market collapse was not an accident. It was a transition, from cheap money to expensive money, from stability to volatility, from one global system to multiple competing systems. And the next crisis will not look like this one, because the system always breaks in the place nobody is watching. But here is the part most people miss. Market crashes are not just financial events. They are social events. They change politics. They change culture. They change how people think about money. After 1929, people distrusted banks. After 2008, people distrusted Wall Street. After this crash, people may distrust money itself. This is why governments talk about digital currencies. This is why central banks research programmable money. This is why financial power is becoming more centralized. Every crisis concentrates power. The question is not if markets will recover. History shows they usually do. The question is who will benefit from the recovery. Because crashes transfer wealth. From the impatient to the patient. From the leveraged to the liquid. From the uninformed to the informed. And that is why understanding crashes matters more than predicting them. The market collapse was not random. It was predictable in hindsight. And the next one will be predictable too. And here is another layer most people don't see. When markets collapse, it's not just investors who react. Governments react. Central banks react. Corporations react. And their reactions often shape the next decade. After the 2008 crash, governments bailed out banks. Trillions of dollars were created to stabilize the system. This prevented a depression, but it also created massive inequality. Asset prices recovered faster than wages. People who owned stocks and real estate became richer. People who didn't fell behind. After the 2020 crisis, governments repeated the same strategy, but on a larger scale. Stimulus checks, emergency loans, massive fiscal spending. This saved the economy in the short term, but it also accelerated inflation. This crash could trigger the same pattern again. When markets fall 30%, politicians feel pressure. They want to stimulate growth. They want to protect jobs. They want to avoid social unrest. So they spend. Historically, massive government spending after crashes leads to two outcomes, either long-term debt problems or inflation, sometimes both. Another hidden consequence is currency competition. When economies struggle, Countries try to weaken their currencies to boost exports. This happened in the 1930s. It happened after 2008. It is happening again. This can lead to currency wars, trade barriers, and fragmented global markets. Globalization is not guaranteed. It is a political choice, and crises often reverse political choices. Another factor is demographics. In the past, crashes happened when populations were young and growing. Today, many developed countries are aging. Older populations spend less and save more. This slows economic growth and makes debt harder to manage. Japan showed this clearly. Europe is experiencing it now. The US is moving in that direction. Slower growth means lower returns, more government intervention, and more monetary experiments. Technology also changes crashes. In the past, information spread slowly. Today, fear spreads instantly. Social media can amplify panic in minutes. Bank runs can happen digitally. Markets can crash faster than ever. But technology also creates opportunities. Automation, AI, and energy innovation could drive productivity. This could offset debt and create new industries. History shows that every crisis destroys old sectors and creates new ones. After 1929, consumer industries expanded. After 1970s inflation, financial markets modernized. After 2008, tech and digital platforms dominated. After this crash, AI and energy may dominate. Another important lesson is leverage. Leverage amplifies gains, but it also amplifies losses. Most major crashes are caused by too much leverage. 1929 had margin loans. 2008 had mortgage leverage and derivatives. Today we have corporate debt, shadow banking, and leveraged funds. When leverage unwinds, prices don't fall slowly, they collapse. This is why crashes feel sudden, even when risks were visible for years. So what should people remember? Markets crash when assumptions break. In 2000, the assumption was that tech profits would grow forever. In 2008, the assumption was that housing never falls. In this crash, the assumption was that money would stay cheap forever. Every crash destroys a belief, and after every crash, a new belief replaces it. The danger is believing the next belief too strongly. Because cycles never stop. The economy expands, debt grows, bubbles form, crashes reset. This pattern has existed for centuries, and it will continue. The question is not whether markets will crash again. The question is when and what will be different next time, because the next crisis will not look like this one. And this one did not look like the last one. The system evolves, and investors must evolve with it, just not obvious.